Hi, and welcome to Process Costing for Chapter 20. Today's lecture is going to be on just that, process costing. We talked about job order costing in Chapter 19, and this is kind of the other part of that. Job order and process costing kind of go hand in hand. Not that they're the same. It's just that you're either one or the other in most respects. So we're going to look at the side of process costing now as opposed to what we've been looking at from chapter 19 with job order costing. All right, here's your learning objectives. Feel free to pause the video. More than likely, let me see, compute process activity cost of per. Yeah, we may not. Yeah, we're not going to get into Appendix 20A. I'm not going to teach you the FIFO method. It's going to be the weighted average method that we're going to use for being able to identify our equivalent units of production, and we'll get into that in a minute. So let's talk about the mass production operations. So we're talking about different companies that are producing the same product over and over again. Here's some examples up here. You got breakfast cereals. You buy a box of Raisin Bran. It's going to probably look a lot like Raisin Bran wherever you buy it. Okay, whether as long as it's from the same company. Pfizer's a pharmaceutical company. Procter and Gamble household products. You got Coke, Pepsi, Hershey's chocolate. Suja, never heard of that one, but organic juice, okay, sounds good. I don't drink juice if I can avoid it, but I definitely do drink Dr. Pepper. So, well, I've tried to kick it a little bit, but anyway, I digress. Point is, all of these items are made in large volumes. They're similar productions. They don't change. It's just a constant change. So we're looking for that kind of process when we're talking about process operations. Things are going to do the same thing. Now, we may have different departments, but the bottom line is that this process does not change over time. And as we do this, we're going to be doing the same thing we did in job order costing by assigning our direct labor, overhead, and materials to the product, but it's just that we're going to standardize them in many respects. So here we're comparing job order and costing systems. With job order costing, we were able to look at our inventory and be able to identify the exact cost of that product. Maybe we could have, if we're looking at it from an accounting 111 standpoint, looking at maybe units of production method, because we could sit there and really identify how many units of what and everything like that with exactness. So we're definitely not, we're going to do FIFO or LIFO with that. But with the process costing system, because we're going to have different products at different points in time, we're not going to know, like in case they're doing roasting, like peanuts, I think. They're making peanut butter in this example, which is just of all the things they could have thought of, they decided peanut butter, but whatever. Point is that how do you know at what point your peanut butter jars are at in the process? Can you tell me how much are in the blending department as you're putting in the peanuts that are smashed or whatever in with all the other items? Do you know how much of your product is in the roasting aspect? You really can't. And so that's kind of the big difference between the two, is being able to identify specifically where your inventory is at any given time. And so we're going to, in the process system, the main crutch of this is to be able to determine our our units of production, where we're at, kind of using a weighted average method. So without further ado, we're going to compute process activity cost using the weighted average method. What we're going to do is we're going to determine our physical flow of units. Where are they at? What percentage are they completed? Where were they at the beginning? Compute equivalent units of production, compute the cost per equivalent units of production, and then assign and reconcile the costs. If you're kind of getting your head kind of jumbled right now, don't worry. We're going to get you there, all right? But it is kind of a four-step process that we're going to follow here. So the first part, we're going to determine our physical flow of our units. So for example, how many units did we have in our beginning work in process inventory, and how many did we started during this period? Well, in this example, we had 30,000 units that were in beginning work in process, and we started an additional 90,000 units. So we know we have to account for 120,000 units. Then we're going to look on it on the other side and look at it, the units completed and transferred out, 100,000 units, ending work in process, what we have left over that will be our beginning inventory in the next accounting period is 20,000. What we need to do is make sure that we've accounted for all of the units that we were supposed to account for. So basically our ending inventory plus the units transferred out should equal our beginning work in process plus our units started for the period. If this formula sounds familiar or you get that kind of vibe of, man, I think I've heard this somewhere before, you have in Accounting 111. We did our inventory there, and remember our beginning inventory plus purchases equals our cost of goods available for sale, and our ending inventory plus our cost of goods sold also equals our cost of goods available for sale. So it's the same concept, except we're calling them different. Instead of units of total units of accounted for is essentially our cost of goods available. All right, it's basically what we have available that we're going to finish or have to account for in our ending inventory. And then our units completed and transferred out is considered like our cost of goods sold, even though it's not sold. But that's just kind of how it parallels the same accounting concepts that you learned in Accounting 111. So don't be dismayed. This does come very similar to what you should have learned in that course. So now we're going to compute our equivalent units of production. And when we're doing that, our focus is going to be on our ending inventory. We're looking at our equivalent units of production to find out how much costs are associated with how many inventory. So in this case, we're looking at units completed and transferred out. That's 100% complete in both direct materials and conversion costs. Remember, direct materials are going to be your raw materials used to build the product, and then your conversion cost is your direct labor and your overhead applied to that. And as we look at these units, we may have 20,000 jars of peanut butter or whatever we're making ready to be, finished. Okay, so it's 20% done as far as the conversion. 100% with materials because we pulled all the stuff we need, so it's done 100%. We just have to put it in the jars, zip it all up, tie it, and then we're good. So it's 20% in relation to the conversion costs, but 100% in the direct materials. That's what we're looking at. So how we're going to do that is we're going to take our number of units that are completed and finished for our direct materials, multiply it by 100 to give us 100 or 100% to give us 100,000 units in our completed and transferred out. And remember, our completed and transferred out units are going to be completed 100% for conversion and direct materials. So whatever we transferred out will be completed 100% for both categories. Now, an ending work in process inventory will be different. Equivalent units of production needs to be calculated based on how much is completed based on what the problem gives you. In this case, it's 100% complete for direct materials. So we're going to include the full 20,000 units in our direct material calculation for equivalent units for $120,000. All right. Now, again, we could have easily said it was 50% complete or 75% complete. It could be any of that, at which point you'll take the number of units and multiply it by the percentage completed. We're going to do that for conversion costs. Conversion costs are completed to 25% of our conversion. We need to get it to where it's a final product. And so we're going to take the 20,000, multiply it by 25% to get us 5,000 units of production, or equivalent units of production, for a total, in respect to conversion, 105,000 units. I said dollars earlier, $120,000. I meant equivalent units of production. We're looking at units right now. All right, so now we got to compute the cost per equivalent unit. When we look at this, we got to take our beginning work and looking at direct materials. We're going to take from our beginning work in process inventory. We're going to take our direct material cost. And then we're going to add the costs we incurred during our period for direct materials. That's going to give us a total. We're going to take that total and divide it by the equivalent units we just calculated from step 2. We're going to do the same thing for conversion costs. We're going to take the $108,900 we incurred from our beginning inventory, because that was already there, and then we're going to add whatever costs we incurred for conversion in this current period. We're going to add those together and divide it by our equivalent units of production, which is 105,000 units. That's going to give us $4.62 per equivalent unit of production. And we know we have $845,100 of production costs we have to account for as well. So with that said, our last step is we're going to now apply those costs to our inventory. So we're going to look at it from ones that are completed and transferred out, and we're going to look at it from respect of our direct materials and conversion costs. You can take the equivalent units that we calculated Then we're going to take our cost per unit that we calculated and multiply them across. That's going to give us $300,000 for our direct materials and $462,000 for our conversion costs, for a total of $762,000. Ending work in process inventory has direct materials of 20,000 units and conversion units of 5,000. We're going to multiply those across by their respective cost per equivalent unit for their totals, add those together to get us $83,100. We're going to add those together and have $845,100, which again is the same amount we were supposed to account for, listed right here. $845,100. We're accounting for it $845,100. So across that spectrum, we're doing it both. We're good. Let's go on, okay? Using process cost information, this is the reason why we do it, all right? We want to control our costs. If we find that something is increasing costs, we want to take action and get it fixed. We want to be able to evaluate managers on the performance of how they're controlling their costs. And we want to know that we make sure that our equivalent units of production help us improve our process. And then, of course, for our financial statements, we need to know how much we've sold and what's in our ending inventory so we can put on the income statement and the balance sheet, respectively. So preparing a production cost report using weighted average. Now, let me pause really quick right here. What we just talked about is the meat and potatoes of this chapter. If you can get and understand the concepts of calculating the equivalent units of production, you're about 85% there with this chapter, all right? So if you didn't understand what you just had me go over and you need to get refreshed, go back again and start over with this video and watch it again. It's going to be important that you understand that before we get into anything else, because everything else is going to start building on that. So please make sure you understand what we just went over. All right, so here's our production costs. This is basically rehashing what we just talked about, but showing it on this huge production report. We're showing the units in step one of what we needed to account for, and then the units that we have accounted for. Then we're going to calculate our equivalent units of production, 120,000 for direct materials and 105,000 for conversion. Then we're going to calculate our cost per equivalent unit, where we get $3 per equivalent unit for direct materials and $4.62 per equivalent unit for our conversion costs. And then we calculate the amount of costs that we need to account for, both our completed and transferred out and our ending work in process inventory. Now, how do we make this flow through our financial statements and our ledgers and everything we got to do? Well, we start off with raw materials. So when we pull our raw materials for direct materials, we're going to put that into our work in process inventory. And we may even pull raw materials in other departments as well. And that's why it's important to know which department you're in and how far your conversion costs are, or excuse me, your direct materials are. Because if you're looking at work in process inventory in the roasting department and you haven't gone to the blending department, then your direct materials are not going to be 100% complete until it gets everything it needs in the blending department. And then you have your indirect material factory overhead, along with other overhead and indirect labor, all going to factory overhead. But you also have direct materials going to your work in process in both your inventory for roasting and blending. Basically, I'm trying to describe this for you. Then we're going to apply the overhead. See, all those costs that we're incurring in 3, 6, and 5 are all what are all the actual costs. Number 7, work in process in both of the different areas. All the materials requisition, your factory payroll, the other head. This is showing you the actual costs, because we still have to do journal entries on how to account for these. So for example, we're going to move our raw materials to we're on number 1, we're buying materials and we're putting them in our raw materials inventory. I saw accounts payable. For some reason, I was thinking, why are we putting in payroll? I don't know. Sometimes I see things and I'm like, whoa, my eyes just wigged out. Anyway, so we're going to pull on number 2 our raw materials, and we're going to put those in both our roasting and blending departments. And then our raw materials inventory will also be credited to move raw materials specific product, but it's going to be helping to account for that. Then we have our labor costs. Number 4, we're going to be putting our labor into work in process inventory and crediting our factory wages payable or debiting our factory overhead depending on the circumstance. If we're recording indirect labor, it's going to be labor related to the factory, but not necessarily specifically related to the product itself. But it is our factory overhead we're applying. Then we're going to account for our factory overhead. Again, this reflects that we are going to make sure that we are applying all of our actual costs to factory overhead. Looks like in this situation, we are a total of $424,992 overhead applied. Okay, and then, yeah, and then our actual will be what we debited. That's a huge difference. See something else, because I see in number 6 that we are applying, that our actual overhead is going to be $275,392, but our factory overhead is applied is $424,992. That's a lot. I wonder if they're going to show us something else that we did. Well, they don't. So the bottom line is we're going to be significantly over applied in this circumstance. So I don't know why they would show that so significantly when we're over 100,000 applied. What we would do in this situation is we'd have to reevaluate our predetermined rate. Seeing that just these two together is what is that, $254,000? No, $354,000. We might need a predetermined overhead rate of like 80% to be more reflective of what this is. So this seems to be either really low or this seems to be really high. But either way, that's what managers do when they see such a cost disparity between the two. They will evaluate that and try and figure out what they can do to get more precise numbers, because that's really what we want. Okay, now we're seeing the transfer of our goods across departments to finished goods inventory and cost of goods sold. So we take our work in process after we apply all of the information, and the top part's in units, the bottom part's in dollars, both from your roasting and blending departments. So we're on the left-hand side, you're roasting, the right side, you're blending. So we're moving 100,000 units to our blending. So our work in process in the blending ends with 15,000 units, and we transferred 97,000 units to our finished goods inventory. In the bottom part, though, we transferred $762,000 of cost to blending, and then blending transferred $1,262,940 to finished goods. So we've completed those things. And so when we do our transfer from work in process inventory to roasting to blending, it's simply a matter of changing our work in process section. We're taking it out of roasting and putting it into blending. Remember, inventory is an asset account, so our normal balance is a debit. So if we're reducing any balance, we've got to credit it. If we're increasing a balance, we're going to debit it. So since we're moving it from our roasting to our blending departments, we're going to debit our blending department's work in process inventory and credit our work in process inventory for the roasting department. Then we're going to account for transfer to finished goods. We're going to take it out of our blending department and send it to finished goods. We saw that it was 1.2 million and change. And our schedule of cost of goods sold is going to show that we have a beginning inventory of 338,000. We add what we just manufactured. So what we have available for sales, the $1.6 million worth of inventory. Subtract out our finished goods ending inventory, and where cost of goods sold is $1.3 million. So we sold $1.3 million worth of items there. Accounting for cost of goods sold, once we sell them, we sell $9 million. So we're going to debit accounts receivable for that amount and then record sales as a credit for $1,915,800 to be precise. But then remember, whenever sale we have, we're selling inventory. We also got to reduce our inventory. So we're going to debit our cost of goods sold and credit our finished goods inventory to reduce our inventory and move our cost of goods sold, or move that inventory to cost of goods sold, so that we can account for the sale of it and expense that now in the accounting period that we sold it in. And for our financial statement reporting, we see $3 million. So our gross profit is $574,740. Keep in mind, this does not take into account any expenses. All right. We're not looking at other expenses, selling and administrative expenses that are not part of this. So that profit margin or that gross profit right there, not a lot. Okay. So hopefully this is in millions. Maybe it is. So it's really $574 million of gross profit. Either way, we still have other expenses we have to account for. The balance sheet, we're looking at just inventory section on the balance sheet. We're going to see $46,950. To calculate the cost per equivalent completed unit, we're going to take the cost of goods manufactured divided by the number of units transferred to finished goods. That's so that we can know how much. At all these other, I know Lean because I actually did Lean for a while, and we looked for inefficiencies in our systems and made sure that things flowed right. So things like this is important and helps a company produce things faster and keep them moving. Just-in-time production, again, we've seen some hiccups. It used to be just-in-time production was a really good thing to have. What it didn't account for was stuff like COVID, when it shut the economy down for most respects. Just-in-time production, all of a sudden there became a screeching halt when the I don't know, the growers stopped shipping because of COVID, and then the people who were going to take it and get into a workable condition stopped. It halted everything, and all of a sudden there were no products. So just-in-time production, maybe the next great thought is going to come from how to avoid that in a way other than maintaining inventory. So who knows? That's something maybe you guys could come up with and figure out a way. Continuous processing services, things like that, robotics and automation, all those things, something that can help with this type of work. Yeah, I'm not going to do this one, and we're in the appendix. So we're pretty much at the end of this chapter. Let me give you your word. Today's word is vanilla, Vanilla. Victor, Alpha, November, India, Lima, Alpha, vanilla, Vanilla. Vanilla is your word. Please make sure you put that into crap, I can't remember what I call it. Video verification. That was the word. Video verification thing, so you get credit for watching this video. So again, we talked in this course about the equivalent units of production. Again, that is the most important aspect. If you get it, that's 80%, 85% of this chapter for us. If you have any questions about anything after watching this video, trying some of the homework, the video, or the Learn Smart, just let me know. Let's get together. Let's figure out what we can do. Otherwise, you guys have a great one. We'll see you later. Don't forget to put that word in there in that video verification document, and we'll see you guys in the next video. Take care.